Okay, so when we're discussing final account, we're explaining what we call capital expenditure in the income statement and revenue expenditure in the income statement and capital expenditure in the balance sheet. So what is meant by the final account? We're looking at the income statement and the balance sheet, and also what we call the cash flow statement. So the objectives of this chapter is to really understand what income is and expenditure and how to prepare an income statement and the balance sheet. And so the final statements are sometimes called the final account. The financial statements are usually prepared at the end of an accounting period. Others do it on a yearly basis, whilst others do it on a semi-annual basis, depending on how your periodicity or period is. Okay. So what are financial statements? Financial statements are simply documents that show the financial performance and the state of the financial position of an organization, usually list of assets and liabilities, including capital in the balance sheet. All right. Then a balance sheet. What do we mean by balance sheet? A balance sheet, the word balance sheet should always end as at. So the balance sheet is the fulfillment of the accounting equation, which we discussed the previous class, where assets are equal to capital plus liability. So the balance sheet is actually prepared and has two sides, which should always be equal. The assets must be equal to the sum of the capital and the liabilities. So what are assets? The assets simply are what the business owns. The organization may own assets in monetary value, and these classifications of the assets may be current assets and non-current assets. So when we're discussing current assets, we're basically looking at those ones that are temporary in nature, and they can eventually be liquidated into what? Cash very soon. So assets are recorded in order of liquidity, starting from cash at hand, then cash at bank, and short-term investments. And we have prepayments, we have receivables, which are simply amounts owing to us through our debtors, and inventory, which we call stock. So give reasons why inventory, receivables, prepayments, cash at bank, and cash at hand are classified as current assets, because these are positions that eventually will be converted into cash. They are the most liquid. Then when we're discussing the non-current assets, we're looking at what we call fixed assets or capital assets. So these ones are subdivided into two. We have tangible and non-tangible fixed assets. So we have land, buildings, machinery, furniture, and fittings. These ones are tangible. Long-term investments, goodwill, these ones are intangible. So we also have liabilities in the balance sheet. These liabilities are simply what the business owes. Okay, these are what the business owes. So we have two types of liabilities. We have the current liabilities. These are simply debts that are payable within a year. Examples are trade creditors. We also have accrued expenses. We also have bank overdrafts. We also have loans that are payable within a year, and tax payable. All these fall under what we call the current liabilities. All right. Then when we go to the non-current liabilities, we are discussing long-term liabilities in Congolese. These ones include loans, mortgages, debentures. So a loan is simply what a bank may give, and this should be repayable more than a year. A mortgage, since This is a loan that is given for an intended purpose and is usually secured against some property. So if a business gets a mortgage and they fail to pay, there is some surety there. And when dealing with a debenture is simply a security that is issued by a limited company at a fixed rate of interest, and they are repayable on terms that they may agree. So what is the difference between a tangible and intangible non-current assets? I explained that already. So we now want to look at the format. When we're going to our balance sheet, the capital aspect is also called owner's equity. So when we go to the balance sheet, we start with capital at the beginning of the period. We add any introduction in capital during the period, add the net profit, if any, we less drawings. Why do we less drawings? Drawings always reduce our capital. So less drawings, anything less, we put it in brackets, then we have capital at the end of the period. This is how we compute capital. All right. So I want us to help me identify of these which ones are tangible fixed assets, non-tangible fixed assets, which ones are current assets, current liabilities, and non-current liabilities from our activities here. So shares in Kamwi Cement Limited, what is this? Machinery in production, what is this? Inventory, what is it? An overdraft. So you can do this exercise at your own free time, just to identify where they fall. So when you're coming up with a balance sheet, it has two forms. There's a vertical format where we start with assets, then down there we go with capital, we add the liabilities. So this is what we call the vertical format of the balance sheet. We also have the detailed form, which is given as follows. We have the fixed assets here, the non-fixed assets there, then the other investments, we put them there. So we're using the vertical form. Then we go to the current assets, cash at hand, cash at bank, prepayments, receivables, and inventory. You see how the order is in order of liquidity, the total there. Then you can total up these assets together to get what we call the total assets here. Then we go to financed by capital plus liabilities. So we have capital at start.
Collins.
Yes, please.
Sorry, kindly ask him for the video after the lesson. I have a meeting that I'm rushing.
Okay, no problem.
Thanks.
All right, so we have capital at start. We add net profit, if any, or subtract loss, if any. We subtract our drawings, then the amount that we get there is our net capital. The net capital, we add the long-term and short-term liabilities, which are current and non-current liabilities. So a 5-year loan, we add it there. The non-current assets, we may have our creditors, accrued expenses, bank overdraft, taxation. So when we add this, the total here, we're going to have, should be able to balance with the total assets here. That's why it's called a balance sheet. So this figure here has to be the same as the figure there. Okay, so here we have information and we're being asked to come up with a balance sheet. So how can we divide this information? So we're going to take this. So this is capital, financed by capital. We add profit to it. Prepaid insurance, this is a current what? Asset, we know it will go. Rent accrued by Kamwi, this is a liability. Receivables, these are current assets. Tax payable, these are current liabilities. Motor vehicles, these are fixed assets. Bank overdraft, this is what? Current liability. Stock, current asset, fixed assets. Current assets, payables, these are creditors. Drawings, we're going to less them from our net profit. And premises, these are what? fixed assets. A 5-year loan is a non-current asset, so we can transfer this in this format. So it's important you know. So the fixed assets, we have the premises, the fittings and fixtures, we total them up. These are our total what? Our total fixed assets. Then we go to the current assets. We had cash at hand, prepayment, receivables, and inventory. When we total them up, we get the total assets. After getting the total assets, we go to finance by. We start with capital at start. We add the net profit. The total there, we less our drawings. If we had a net loss, we will subtract the net loss from the capital at start. So this is our capital, net capital we have. Then we have our accounting equation. So assets must be equal to what? Must be equal to capital, which we have here, plus liabilities. So the liabilities were both long-term and short-term. The long-term are called the non-current liabilities. So the 5-year loan, we added to that one. In the current liabilities, we have payables, bank overdraft, tax payable, accrued expenses. All these collectively, we add to this. So when we get this figure, we add 1, 2, 3. We have 83,900, which is the same here as 83,900. So this is how the balance sheet must look like. Right. So just on the balance sheet, I'll need you to come up with a balance sheet that will balance from this data that we have here. You can capture this. That will be your homework to prepare a balance sheet based on the information that we have there. Make sure it balances. And I need you to appropriate the information accordingly. Appropriate the information accordingly. Any questions? All right. So we end here. Have a good day. Thank you so much.